Good evening. Welcome to Ponzinomics. I'm Alex.
Hi everyone, I'm Sam. Tonight, something different. No fraud, no falsified accounts, no missing billions in Philippine bank accounts. Tonight's story is something almost more unsettling. A group of the most intelligent people on the planet built the most sophisticated financial models ever created. They were certain the models were right. The models were wrong. And they nearly took the global financial system down with them.
Long-term capital management. 1998. The year that genius failed.
Spectacularly.
Long-term capital management was founded in 1994 by John Meriwether. Meriwether had been the vice chairman of Salomon Brothers and head of their bond trading desk, a desk that, at its peak, was responsible for somewhere between 80 and 100% of Salomon's entire global earnings. He was, by any measure, one of the most accomplished bond traders alive.
He'd also resigned from Salomon in 1991 amid a bond trading scandal. Worth mentioning.
He started LTCM in Greenwich, Connecticut, and assembled a team that was, and I don't use this lightly, extraordinary. Two of his board members were Myron Scholes and Robert Merton.
The Nobel Prize winners.
They won the Nobel Prize in Economics in 1997. While LTCM was still operating, for developing the Black-Scholes model, the mathematical framework underlying modern options pricing, the most influential financial equation of the 20th century.
So they had two actual Nobel laureates running a hedge fund in Greenwich.
They also had David Mullins Jr., the former vice chairman of the Federal Reserve, a man who was at one point considered a possible successor to Alan Greenspan. The fund started trading in February 1994 with just over $1 billion in capital. The first year returns were 21%, the second year, 43%, the third year, 41% after fees.
Those numbers are extraordinary.
They were. LTCM was, for a few years, the brightest star on Wall Street. The core strategy sounds simple, though executing it was enormously complex. They looked for pairs of financial instruments, bonds typically, that should theoretically trade at a predictable relationship to each other. When that relationship diverged, they bet that it would converge back. Buy the cheap one, short the expensive one. Wait for them to come back together, pocket the difference.
The problem being?
The differences are tiny. We're talking fractions of a percent. To turn tiny differences into significant returns, you need to make enormous bets. And to make enormous bets, you need to borrow enormous amounts of money.
Leverage.
By the start of 1998, LTCM had equity of $4.7 billion, but they had borrowed over $124 billion, a debt-to-equity ratio of more than 25 to 1. And that's before you count the off-balance sheet derivative positions, which had a notional value of approximately $1.25 trillion.
Say that again.
$1.25 trillion in derivative positions on $4.7 billion in equity.
They turned $4.7 billion into a $1 trillion position through leverage. That is either the most impressive or the most terrifying thing I've ever heard.
Both, I think. Their strategy had been described, accurately, as picking up nickels in front of a bulldozer. Small, reliable gains. The risk being, if the bulldozer hits you, it hits you at full speed. Not everyone was convinced. From the very beginning, there were people raising concerns.
Who?
Warren Buffett and Charlie Munger were approached by Meriwether in 1993 to invest. They analyzed the fund and turned it down. They considered the leverage plan too risky.
Warren Buffett looked at it and said no. And yet, 14 of the world's largest banks were perfectly happy to lend them $124 billion, without, apparently, asking too many questions.
The fund was very secretive about its specific operations. It scattered trades among banks, so no single institution could see the full picture. And since the profits kept coming in, nobody pushed too hard. As one account put it, since long-term was flourishing, no one needed to know exactly what they were doing.
No one needed to know. Because the numbers were good, and when the numbers are good, nobody asks how the magic trick works.
By 1997, the returns had slipped to 17%, still excellent, but below earlier levels. The reason? Too many competitors had noticed what LTCM was doing and started copying the strategies. The arbitrage opportunities were getting smaller as more people exploited them. So LTCM did what funds often do when their edge erodes. They looked for new opportunities. Emerging markets, foreign currencies, equity volatility, areas where they had, as Myron Scholes himself warned internally, no particular informational advantage.
One of the Nobel laureates on the team flagged this internally, and they did it anyway.
They did it anyway. Here is the most important thing to understand about LTCM's collapse. It wasn't that the mathematics was wrong. It was that the mathematics was incomplete. The models were built on 5 years of historical financial data.
5 years.
5 years. The historian Neil Ferguson later wrote about this. He said, and I want to get this right, that if the models had gone back 11 years, they would have captured the 1987 stock market crash. If they had gone back 80 years, they would have captured the last great Russian default after the 1917 revolution. Meriwether himself said after the collapse, "If I had lived through the Depression, I would have been in a better position to understand events."
The Nobel Prize winners knew the maths. They didn't know the history.
Ferguson's verdict on LTCM was precise. The Nobel Prize winners had known plenty of mathematics, but not enough history.
That is one of the most devastating sentences I have ever heard about anyone.
The models calculated that the losses LTCM eventually suffered in August 1998 were so statistically unlikely, so far outside the expected range, that they ought never to have happened in the entire life of the universe.
In the entire life of the universe.
That was the model's conclusion. And then it happened. In August 1998, on the 17th of August 1998, the Russian government defaulted on its domestic debt, its own bonds, in its own currency.
Which people thought was impossible.
Right. It was thought to be essentially impossible. The traditional economic logic was, a government can always print more of its own currency. It never needs to default on debt denominated in that currency. Russia did it anyway.
Tremendous. Another government that didn't read the textbook.
The effect was immediate and catastrophic. Investors worldwide panicked and fled to safety, buying the most liquid, most reliable assets they could find. U.S. Treasuries, German bonds, the things everyone knows are safe. LTCM's strategy was built on the assumption that cheap, illiquid assets and expensive liquid assets would converge. In a panic, they diverge massively. The cheap assets got cheaper. The expensive ones got more expensive. LTCM was on the wrong side of everything simultaneously.
Every position they had went bad at the same time.
Every position. Victor Hagani, one of LTCM's partners, described it this way. It was as if there was someone out there with our exact portfolio, only it was 3 times as large as ours, and they were liquidating all at once.
Which is basically what was happening, because everyone had copied their strategy.
Exactly. The copycats were also in trouble, and their forced selling made LTCM's positions worse, which forced more selling, which made everything worse. By the end of August, LTCM had lost $1.85 billion in capital. By mid-September, their equity had fallen from $2.3 billion to $400 million. With liabilities still over $100 billion, their effective leverage ratio had reached, and this is the number, 250 to 1.
250 to 1. Against them.
The Federal Reserve Bank of New York became very concerned. LTCM was counterparty to so many institutions in so many markets that an uncontrolled collapse could trigger a cascade of failures across the entire global financial system. This was the fear. If LTCM was forced to sell everything at once, the resulting crash in prices would force other institutions to recognize losses, which would force them to sell, which would crash prices further.
The system eating itself. Leverage is great when you're winning.
Goldman Sachs, AIG, and Berkshire Hathaway put together an offer, $250 million, to buy out the partners' stakes, plus a $3.75 billion injection. Warren Buffett gave Meriwether less than 1 hour to accept.
He turned him down once already when the fund was starting. Now he's offering $250 for the whole thing.
The offer expired. The deal wasn't done in time. The Federal Reserve Bank of New York then stepped in and organized a consortium of 14 of the world's largest banks: Goldman Sachs, Barclays, Deutsche Bank, Merrill Lynch, JP Morgan, Morgan Stanley, UBS, and others, to provide a $3.625 billion bailout. The banks received 90% of the fund. LTCM's partners received 10%, but it was entirely consumed by their own debts. The partners had $1.9 billion of their own money in LTCM. Every dollar wiped out.
They lost their own money too.
Every penny. Bear Stearns and Lehman Brothers declined to participate in the bailout. Both of them would later collapse in the 2008 financial crisis.
Make of that what you will. Maybe there's a future podcast about that.
Yeah, maybe. David Mullins, once considered a possible successor to Alan Greenspan at the Federal Reserve, saw his future in public service end. The Nobel Prize winner's theories took an enormous public reputational hit. Merrill Lynch later wrote in its annual report that mathematical risk models may provide a greater sense of security than warranted, and that reliance on these models should be limited.
The bank that helped create LTCM was writing in its annual report that you probably shouldn't trust mathematical models too much. After the event, helpful.
The UBS chairman resigned following a $780 million loss his bank took from derivative positions linked to LTCM's collapse.
And Meriwether?
He launched a second hedge fund after LTCM called JWM Partners. In the 2008 financial crisis, that fund lost 44%. It was shut down in July 2009.
And then?
He launched a third hedge fund in 2010, using essentially the same investment strategies as LTCM.
A third, after 2 failures. Same strategies. John Meriwether launched a third fund.
He did.
This time it's different, right? Here's what separates LTCM from almost everything else we've covered. There was no lie here, no falsified accounts, no money being siphoned off. These people genuinely believed the models. The partners put $1.9 billion of their own money in and lost every penny of it. If this was a scam, it was the most expensive self-inflicted scam in history.
Which is precisely what makes it so instructive. The danger wasn't dishonesty. It was certainty. Complete, unshakable certainty that the mathematics had captured reality. That 5 years of data was sufficient to model the behavior of complex, irrational, historically contingent human markets. That a Russian government default in rubles was so unlikely as to be essentially impossible.
They were so confident they were right that they borrowed $124 billion to prove it. And they were wrong.
The leverage was the weapon. The certainty loaded it. A small discrepancy in a bond trade is harmless. A small discrepancy at 25 to 1 leverage is catastrophic. At 250 to 1, it's systemic.
Buffett saw it. He walked away. The Nobel laureates didn't see it. They walked into it. There's something deeply uncomfortable about that.
Neil Ferguson's line haunts this story. They had known plenty of mathematics, but not enough history. History is full of events that models say should be impossible. Sovereign defaults, market panics, earthquakes, plagues. The things that fall outside the data range are precisely the things that destroy you, because you haven't prepared for them.
The universe is apparently somewhat longer than 5 years. So, what did we learn?
That leverage multiplies both gains and losses with perfect indifference. That a model is only as good as the history it captures, and history is full of events that haven't happened yet. That certainty in financial markets is not a sign of sophistication, it's a warning sign. And that when Warren Buffett declines to invest, it might be worth asking why.
2 Nobel Prize winners, a former Federal Reserve vice chairman, the most sophisticated financial models ever constructed, a $1 trillion derivative position, 5 years of historical data, 1 Russian default, 4.6 billion in losses, 14 banks, a third fund. The Nobel Prize winners had known plenty of mathematics, but not enough history.
Next episode, we cross the Atlantic to Glasgow. A football club founded in 1872. A new owner who bought it for £1. A tax avoidance scheme called the Employee Benefit Trust. Administration, liquidation, and one of the most controversial chapters in Scottish football history. Rangers FC.
This time it's different, right?
It never is.